Hello there. This is Scott Hayes. I'm here again to talk about the market and the update for the second quarter and what's going on out there and what we anticipate going through the third quarter and beyond. I'm going to start off with to talk a little bit about federal finances today. As we know, we're running pretty large fiscal deficits in this country right now. In fact, we're going to have to borrow about $1.915 trillion in fiscal 2024 to make up the gap for what we're spending in the government versus what we're bringing in all forms in terms of taxes. Looking at what's going to happen, this is a big year in terms of a presidential election cycle. And we can see on the right hand upper column there, the debt or surplus is laid out there. And then the forecast is put together by the Congressional Budget Office. It's their baseline for going out for the following 10 years. And what we see here is that their baseline um, forecast is that the budget is going to run a fiscal deficit of nearly 6% a year, every year, just based on current trends in that. And if TCJA, that's the Tax Cuts and Jobs Act, if former President Trump is reelected, there's a good chance that they would extend those, as we're looking at even higher fiscal deficit of nearing 7% of GDP. So we have, under the baseline, we'd be at about 120% of GDP, debt to GDP by 2033. And under TCJA, and this assumes no recessions or anything of that nature, we're approaching 133% of debt to GDP. So at some point, we're going to have to address this. Neither party is talking about that in either platform right now. So either way, we're likely to extend the debt and the deficit over the following 10 years. We all know we've come off this inflationary cycle. Inflation did peak back in September of 2022, July of 2022 at around 9.1%. It's come down since. The only worrisome part about that is if you look to the right, from July of 23 to where we are today, around 3.3%, it's pretty well flatlined. And the Federal Reserve has stated their intention to get towards a 2% inflation goal. And so we still have a ways to go with that. And you can see from this graph, the components of inflation, what's driving inflation. It's still dominated by shelter cost, owner's equivalent rent. It's come down some from the peak, of course, but it's still there. And auto insurance, those make up the primary sources of inflation still today. What that means for interest rates, there have been some softening in the economy lately. Economic growth came in at 1.4%, I believe, on the second quarter. So it is growth has come down. Job openings have slowed down. Less people are quitting their jobs today than they were a year ago, and so all of that is leading most market economists and so forth. The market is basically anticipating a rate cut by the Federal Reserve in September with almost 100% certainty. Never know. I mean, they are data dependent, so things could change. But it looks like they're probably going to cut in September, maybe one more time before the end of the year. It's hard to say. And the current estimate is that they're going to cut maybe four more times in 2025. So we'll see. They have a long run projection. The FOMC long run projections at 2.8%. Whether or not we get there, there are some cyclical structural issues that would prevent it from going much higher over time, just with the amount of the debt and so forth that I mentioned previously. So we'll see about that. Now the yield curve has now been inverted for 24 months in a row, which is an all-time record. It's never happened before. We do see from this graph, at the bottom there in August of 2020, that's what a normally sloped yield curve looks like, where you're paid more to hold long-term debt than you are short-term debt. But as I said, it's been inverted, where now for the last 2 years, you've been paid more for owning the short-term debt than longer-term bonds. But it has been flattening. We see here on June 30th, it's almost flat between the 3-year, 5-year, and all the way up to 30 years, around 4.3 to 4.5%. So it has flattened quite a bit. If the Fed does cut the short-term rate here in September and beyond, we're going to see that short end of the curve also start to go down and make for a more normal-looking curve over time. What that's led to with short-term rates so high is CD rates have been really high, and people have a lot of money in cash, right? You can make 5% or around that, or maybe even a little more without any investment risk. in the traditional sense. And so, a lot of money is flocked into CDs and cash and short-term instruments. But what this shows is from historic peak rates in CDs, which they peaked last, I think it was September. Subsequently, the following 12 months from there, you see that, on average, bonds have averaged 15% a year and stocks have been 22%. So far, since they peaked, the aggregate bond market is up about 6%, and stocks are up over 30%. So even though you've been paid well to have money in CDs, there have been better opportunities in both stocks and bonds, for longer term investors. Now we know, the market is pretty rich right now by most historic valuation measurements. We've talked about this before. The market is fairly pricey by price earnings ratio, by historic dividend yields and earnings yield spreads and all of that. But that has been concentrated in a few names, which I'll talk about here momentarily. Also, I mentioned this one as the most important graphic on last quarter's update. Investing at all-time highs. We have had 30 plus all-time highs in the market so far through the first 2 quarters of 2024. So again, if you thought the market was expensive back in December of last year, you're on the sidelines, or maybe you're in CDs and the short-term stuff. What that indicates is that looking at the chart here, those all-time highs, more than 30% of the time, are the floor. There's never been a better time to get in than that all-time high. And, we've seen that over and over again this year so far. I would expect it's not going to go up like this forever. We are going to get some kind of a meaningful pullback at some point, but you can't invest that way because you just never know when it's going to happen, particularly if you're longer term dollars. I mentioned concentration. It has been a very narrow market. The top 10 stocks in the S&P 500, you can see on that upper right-hand chart here, make up 37% of the entire weight of the S&P 500. So the diversification benefits that you typically get from owning a broad-based index fund aren't so diversified right now. We think that a lot of that's caused by the excesses from the low interest rate environment we've had, where that's just led to this kind of a concentrated market, if you will. And of course, even narrower than that, we've had the Magnificent Seven. Those 7 technology names, everybody knows them. They are up year to date here in 2024, 33% through the end of June. And that's made up 61% of the return of the market. I think the S&P year to date was up around 18% through June 30th. So more than 60% of that return was just in these 7 company names. So, what that tells you is if those go back the other direction, they have a meaningful pullback. You could also have a meaningful correction in the overall index because of that concentration that I mentioned a moment ago. The growth is there to back it up at some level. Earnings growth on the Magnificent Seven versus the rest of the S&P 500. They have historically had higher earnings, but whether or not they can grow into that, is yet to be seen. And you see at the bottom right-hand corner there, the dispersion between the best performing Mag 7 stock and the worst one. It's quite a range. We all know the one, that's up 149% year to date. The worst one's down 20%. So we're starting to see some entropy and some breaking apart of that Mag 7. We'll see how things go from there. But, the other 493 stocks that make up the S&P 500 aren't as pricey. And so, there's some thought that maybe those will, carry the weight, if you will, if the other ones start to fall off a little bit. There are some good tailwinds to the economy and the market. We're all talking about AI, and all the firms are talking about AI on their earnings, calls and so forth. And then what this shows here on the left-hand column is the hyperscalers, the data centers, are spending $183 billion in 2024 on capital expenditures for building stuff. And that's about a quarter of the entire spend on building stuff this year. And so that does represent a tailwind for economic growth, as well as productivity gains, that might be gained from the adoption of AI technologies. The flip side of that, these data centers demand a tremendous amount of energy. And we see here that, with between data centers and crypto mining, just from 2022 to what's estimated in 2026, we're increasing by about 1.8 times the current strain on the electrical grid. And in fact, that's around 6% of the entire energy requirement, I believe, that's out there. So, and even though in the bottom right hand, we do have a lot of AI adopters in the IT and professional and technical side, the remaining categories of different types of companies aren't yet, they haven't really implemented much, if any of it. And so there's still a long way to go, for AI, and we're at the very early innings of this trend. And so, we expect that's going to lead to gains in productivity over time, but also, again, a strain on electrical capacity as it continues to grow. Now, all investments aren't created equal, obviously. We've talked about how expensive some stocks are in particular right now. And what this is, the Z-score basically just takes the expensiveness or cheapness compared to averages. And what this shows you is that, if you look at the right-hand side, the price-earnings ratio of U.S. large company stocks is around 1.48, so nearly 50% more expensive than average. And that's up from 100% back in just at the beginning of the year. Other asset classes like bonds, which we mentioned a little bit, as you go to the far left side, the yield to worst on treasuries, they appear relatively cheap to historic averages right now. Fixed income valuations, I've shown this before. This is the range of yield to worst across different fixed income sectors over the past 10 years. You see, for example, U.S. Treasuries on the left-hand side there have ranged from almost 0 to north of 5%. Their average over the 10 years has been 1.8%, and we're still sitting at about 4.6%. So fixed income does appear to us to be relatively attractive compared to stocks, especially because you get that coupon, the interest rate. And then if rates do come down, which is an if, there can also be some price appreciation in the value of those underlying bonds. So that's it for this time. Here's the disclosures that we have to provide. And anyway, thank you for joining today. If you enjoy this, we ask you to please like and subscribe. Thank you.